Imagine making one investment so bold that it instantly becomes the biggest position in your portfolio. This is exactly what one of the world's top investors just did with a $2.2 billion bet. And the company, it's not some secret startup, it's one you've probably used this week. In this video, we're uncovering who this investor is, why he just went all in on one stock, and why some are calling him the next Warren Buffett. All right, guys, so who's behind this $2.2 billion bet? Bill Ackman. You've probably heard his name. Now, this guy isn't your typical Wall Street investor. He is the billionaire founder of Pershing Square Capital, and his investment style, he plays the game like a sniper. 10 stocks or less, ultra concentrated, high conviction plays. When he sees value, he doesn't dip his toe in. He cannonballs into the pool. Ackman made headlines with legendary plays like buying into Chipotle as they were turning around from the E. coli scare several years ago. He made billions with Canadian Pacific Railway and even backed Universal Music Group before it went public. Now, his philosophy is very simple. Find great businesses with predictable future cash flows and buying them when they're misunderstood or mispriced. Does that sound familiar? He wants durable moats, good management, and free cash flow. That is classic value investing. So today, we're going to reveal the stock that Ackman just put $2.2 billion into. It's not some hidden microcap or some sexy AI startup. It's a company that you probably use on a weekly and maybe even daily basis. And trust me, once you hear the name, you'll understand why exactly he's all in. It's actually a company that we've talked about in this channel and said sounded very interesting. So stick around. We're breaking it down, and I will show you the price I would buy it at. Now, before we get into his massive $2.2 billion bet, which we were going to reveal, I want you to understand the foundation of what Ackman is trying to create. Because to really get why he's making that move, you need to see the bigger picture. And I'm going to break this down real simple, hopefully on a 5th grade level. He's trying to build something much bigger, something lasting. He's trying to become a modern day Warren Buffett, and those are his words. He wants to turn Howard Hughes Holdings into the next Berkshire Hathaway. Now, if you're new here, Berkshire Hathaway is Warren Buffett's legendary holding company. It was actually a failing textile business that he bought out of spite over time, and he used it to consolidate all of his partnerships into one. And he used it to buy insurance companies, banks, railroads, Coca-Cola, Apple, and today it's worth over $1 trillion. And the wild part is, Ackman's been dreaming about this for decades. He tweeted in February of this year, "I first learned about Warren Buffett from a college classmate when I was 20 years old. 4 years later, I read my first Berkshire Hathaway shareholder letter, and I was inspired to become an investor. When I entered the investment business at 26 and started a hedge fund with only $3 million under management, I thought that perhaps someday I could build a diversified holding company like Berkshire with an extraordinary long-term record." One of the most compelling parts of the story is Berkshire's modest beginnings. Berkshire was a dying textile company losing out to foreign competitors. The story of how Buffett bought control of the company, redirected cash from a dying business into an insurance company, a bank, manufacturing businesses, a railroad, securities portfolio, and more is legendary. A big part of the appeal of Berkshire is that anyone who could afford one share, which was about $20 back in the early 1960s, could participate in the compounding of that value over time. Now, those are his words. So what's his plan? Bill has this company called Howard Hughes. He's been building a position in there. They're a real estate play. They build neighborhoods, cool buildings. But now he's turning it into something much bigger. Imagine it like a giant launch pad. He's going to use the cash flow from that business and buy other awesome companies. But he's not buying them just to sell them fast and make quick money. He wants to find strong, smart companies that make money year after year, and he wants to keep them forever, like collecting the best baseball cards and never trading them. And get this, Bill's already put $900 million of his own money into this plan. So clearly he is serious. Now let's compare Bill Ackman to Warren Buffett and ask the big question. Does Ackman have the ability and the credibility to pull this off and make that $2.2 billion bet really pay? Now, if you know much about Warren Buffett, early on, he made highly concentrated bets. He sat there and said, listen, in order to outperform the market, I've got to make small bets, 8 or 10 positions that are massively mispriced. Bill Ackman likes doing the same thing. So what's Bill Ackman doing buying Howard Hughes and trying to make it a diversified holding company? Well, the same thing they did with Berkshire Hathaway. Over time, Berkshire Hathaway got so big and had so much money that it was hard to massively outperform and make highly concentrated bets. Imagine it this way. Let's say you have $100 billion versus $100 million. If you have $100 million, if you make 10 bets that are $10 million each in the stock market on small companies, you can make a killing. In fact, Warren Buffett has said before that if he had $1 million, he guarantees he can make 50% per year. Why does he say he could guarantee that? Because I think Warren Buffett does that on the side. He has his own personal account and he makes those bets. But when you have $100 billion, a $10 million investment is not going to move the needle, even if you make 100% of your money. So the larger and larger you get, the more diversified you need to be. Can you still outperform? Well, we've seen it with Warren Buffett. He's outperformed the market in the last 10 years. Now, his outperformance as time goes on decreases. Why? Because he has so much money sitting around. So Bill Ackman, even though he makes concentrated bets, including this $2.2 billion bet, as he gets bigger, he has to be more diversified. Now, let's look at some of Warren Buffett's biggest investments. In 1988, Buffett invested just over $1 billion into Coca-Cola. He is still holding those shares. Today, they're worth over $25 billion. And on top of that, they pay him around $700 million a year in dividends. No rebalancing, no exit strategy, just pure, unshakable belief in the brand. That's Buffett in a bottle. Buy quality, hold forever, and let time do the compounding. Now compare that to Bill Ackman in 2020. Markets are collapsing, fear was everywhere. And while most people were selling, Ackman made a $27 million bet on credit default swaps. Sound familiar? Yeah, that was a thing back in 2008. Now within a month, 1 month, it turned into $2.6 billion. That's 100 times your money. That's not patience though. That's precision, timing, strategy, and guts. Ackman doesn't wait for the wave. He sees the storm coming and turns it into a payday. Now, what's Buffett's most surprising win? Apple, and that was more recently. The man who swore off tech stocks made Apple his biggest holding starting in 2016. And by the way, Warren Buffett's not against tech. Back in the early 2000s, he just said, listen, I don't know if I can predict the cash flows of these tech companies for the next 20, 30 years. But last year's tech is today's blue chip. Apple has become today's blue chip. It had loyalty, cash flow, predictable cash flow, pricing power, everything Buffett loves. You want to talk about pricing power? Buffett always said, if you gave somebody the option, get rid of your iPhone for a year or get rid of your car for a year. He goes, I'm pretty sure everybody's going to pick the car to get rid of and keep the iPhone. And it makes sense. At its peak, his stake in Apple is worth $174 billion. He has since trimmed it, but it still dominates Berkshire's portfolio. Now, Ackman, he took an aim at Chipotle during its worst moment, a food safety crisis that tanked the stock. In 2016, he jumped in with a $1.2 billion stake, and then he got to work. He pushed for changes, he cleaned up operations, he restored trust. Today, it's up more than 500%. Buffett had built empires, Ackman had fixed them, but no one wins forever. Buffett's biggest blunder? Dexter Shoe. In 1993, he bought the company using $433 million in Berkshire stock. That was back in 1993. The business failed. The stock he gave up would be worth over $15 billion today. His words were, this is an unforced error. Now Ackman, his pain came from a very public war, Herbalife. He shorted the stock. Hey, welcome to the club there, Ackman. He called it a pyramid scheme and he made it personal. For 5 years, he fought. In the end, he lost over $1 billion and maybe more in reputation. Conviction is a strength until it isn't. Buffett once found himself in a different kind of crisis. The Salomon brothers that he invested $700 million into. Then, the firm got caught in a trading scandal. Buffett stepped in as the interim chairman, not for profit, but to restore trust. The deal didn't make him rich, but it cemented his legacy as a principled leader. Now back to Ackman. He had Valiant Pharmaceuticals. Ackman believed in the business deeply, publicly, but scandals, price hikes, and public pressure brought the company and his investment crashing down. He held on too long. So here's what we've learned. Buffett plays the long game. He buys slow. He holds steady. He lets the world catch up to his vision. His weapon of choice is patience. Bill Ackman strikes with intensity. He sees the cracks. He bets hard. And sometimes he even reshapes an entire company. His weapon is conviction. They both win. They both lose. But they always bet on what they believe in, and that's what makes them icons. Between Valiant Pharmaceuticals and Herbalife, Ackman has lost billions. but he has made so much more on his bets that worked out. The market isn't just numbers, it's emotion, it's timing, it's belief, and knowing when to act or knowing when to wait. And guys, that timing part is very difficult to get right, and there's probably only a few people out there who can do it. Buffett is not one of them, and he doesn't try to be. Now, the biggest bet Ackman has ever made. Here it is. Uber. $2.2 billion into Uber. Now let's show you all of Bill Ackman's holdings. Guys, here are his holdings. Uber, Brookfield Corp, Restaurant Brands International, the Howard Hughes right here. And he's reduced his positions in Chipotle, Canadian Pacific, Google, added his Google Class A shares, Hilton, Hertz. Hertz is a big one because Hertz declared bankruptcy and he made a bet on them. So guys, as you can tell, he is increasing this $2.2 billion in freaking Uber. That's an incredible bet. Now, we've talked about Uber before. Let me remind you about Uber. Let's go take a look at it right now in our software because we've talked about this company at length. It's a $195 billion company. Now remember, it's hard to make outsized returns with a $195 billion investment. But they've got growing cash flow, $7.8 billion last year, $1.9 billion over the last 5 years. So this shows there's been massive increase lately. It's only selling for 25 times free cash flow. 25 times free cash flow, guys. It's selling for 16 times earnings. Now, guys, if you're new to the channel, I don't care if you're a beginner investor or advanced investor, I tend to go through these numbers a little quickly. Just be patient. Trust me when I say that if you take a few videos to understand these things, you will come out of this knowing more than 99.5% of the world about a lot of things having to do with numbers, money, and finance. I absolutely guarantee that. It just takes a little bit of time, and I'll give you a way to get these things a little bit better later on in the video. Now, let's go take a look at... Now, by the way, if you're a community member, put your rating in here. Right now, we only have 6 votes on Uber, and right now, the average rating is a buy, with 4 people saying buy and 2 people saying strong buy. It's another great thing about our community. You can go in there and give your rating. So please take the time, if you're one of our community members, to go rate Uber on what you think about it in terms of value. Let's go check out the 8 pillars. Okay, so here's what's interesting. 5 X's, 3 checks. That tends to happen with fast-growing companies. Cash flow growth, net income growth, revenue growth, the rest of it all feels like junk. But keep in mind, guys, for example, look at this debt here. 9.4 times their 5-year free cash flow. Guys, their free cash flow last year is 5 times greater than the last 5 years. So if you base it on last year's free cash flow numbers, this 9.4 is now a green check, and it's like 1.8 times debt levels. So pretty reasonable. Shares outstanding, and they're a startup. It was going up. I don't know how that's good, but look at these PE ratio. Ignore. Price to free cash for the last 5 years, ignore. So I'm looking at this going, guys, I don't think there's anything wrong with this. Let's see what analysts think. On the analyst front, they're looking at over 2.5 times increase in their earnings in the next 3 or 4 years. Those are huge numbers, guys. And revenue growth, look at this, 15%, 14%, 14, 11, 10. As time goes on, my guess is their revenue growth will be overall declining, but they still have a lot of room to grow. This is a great company with great margins that have overcome their biggest obstacles, which were the cities. So guys, in a few minutes here, we're going to combine the story with the numbers in our stock analyzer tool. And the reason that's so important if you're new to the channel is you've got to be able to determine what the right price to pay is. We have to make assumptions about the future based on the story, and that all converts into a number of what's right to pay today. But before we get there, Bill Ackman had a tweet recently. On February 7th, he wrote, beginning in early January, we began acquiring a position in Uber. Today, we own 30 million shares. I've been a longtime customer and admirer of Uber, beginning when Edward Norton showed me the app in its early days. I was also fortunate to be a day one investor in the company through a small investment in a venture fund. While a great business, Uber suffered from erratic management. Since he joined the company in 2017, Dara, I'm not even going to try to pronounce that last name, has done a superb job in transforming the company into a highly profitable and cash-generative growth machine. In fact, what I like about what Dara said, I love that he said, at one point in 2022, the market has shifted. We need to focus on cash flow now. We can't just keep spending on growth. We've got to focus on generating cash flow. And he did a wonderful job in doing that. We believe that Uber is one of the best managed and highest quality businesses in the world. Remarkably, it can still be purchased at a massive discount to its intrinsic value. This favorable combination of attributes is extremely rare, particularly for a large cap company. We will have more to share about our thinking on the company shortly. Well, that position's pretty big, guys. So guys, I'm going to slow down here. This is where a lot of people might miss the bigger picture. Let's explain how we got here. This might sound obvious if you've been watching us for a while, but it's important for the new folks to hear this. The fifth tenet, and the most important tenet of our principle-driven investing, is very simple. A great story can become a bad investment if you pay the wrong price. But people always quote Munger and Buffett saying, oh, you got to find a great company and it might be expensive, but you should buy it. Well, they take that to mean pay whatever price. No, what they said was an expensive looking price. When they bought Coca-Cola in 1987 and 88, they paid 30 times earnings. That looked expensive, but they've still, with dividends, made almost a 12% return on the money. Not bad for such a big investment. Now, guys, I've talked about Uber. I think everything he said here is correct. The question is, can the price be appropriate? Because look at this, guys. There were times when this company wasn't making any sense, but the stock is up a ton in the last 5 years alone because their cash flow generation has really, really compiled, and that's what's great. Now, guys, whether you're a newbie or somebody who's been part of our channel, I want you to do me a favor. We have a free PDF I want you to download. This PDF is going to go across all the metrics here. We're changing the screen just a little bit to make it more simple, but the main metrics, it's going to tell you what the metric is and explain it further. That way, when you're watching videos, if you get a little confused, you can pause it, pull it up, and read about the metric so you have a better understanding. The key here is we want everyone having the same foundation. I don't care what level you're at in investing. If you're a beginner or advanced, this PDF is for you. It's to put us all on the same page so we're speaking the same language. Very simple. So click the link below and you will get the PDF sent to your email within a matter of minutes. Now, let's go to our stock analyzer tool to figure out the right price to pay for Uber. So guys, I'm doing a 10-year analysis here. This stock analyzer tool is going to ask me for low, middle, and high assumptions. For revenue growth, the very first level, revenue growth, I did 5, 8, and 11%. Profit margin, I did 10, 18, and 26. Now, here's what's interesting. Last year, they did 27. So is this too low? It might be. But this will just go to show you how incredible the stock could very well be. Free cash flow, I did the same thing, 10, 18, and 26. Free cash flow has to catch up a little bit here, but it will. PE, I did 18, 22, and 26. Guys, this company is absolutely a phenomenal company. There was a saying they had that it took somebody using Uber twice before they were addicted for life. That's pretty sticky, pretty incredible. That deserves a premium. Is this enough premium? I don't know. That's what makes investing such a great art. You get to decide what you're putting in there. And finally, I'm putting in 9% desired return, no margin of safety, just saying, hey, what's the intrinsic value? Intrinsic value to me feels like what would it have to sell for me to match the market's return? 9 or 10%. I hit the analyze button. And guys, here's where it gets interesting. A low price of 42, high price of 228, a middle price of 110. And guys, I think my margin might be low. And I don't blame Bill Ackman at all. Now, guys, if you made it this far in this video, you're probably really serious about investing and learning about it. And I mean really serious. You'll need to hear what Warren Buffett has said in a recent message. He laid out a roadmap for what the next decade of stock investing could look like. This isn't just motivational fluff. It's a powerful, real-world lesson from the greatest investor of all time. So if you want to understand what's likely coming next, click the video linked on your screen. Thank you for your time.